In the cloud. Welcome to the Top M&A's Entrepreneurs Podcast. My name is John Stoddard. I have a guest today, Arturo Henriquez. And the reason I brought him on is I was on Amazon and I got this book called Buy Yourself an Entrepreneurship. It is an excellent book. Get it? I'm going to read just a little bit about who Henriquez is, Arturo. He's been involved in over 130 business purchases and business deals. He's bought restaurants, tequila company, consumer goods company, technology company, bars, nightclubs, pest control, fast food restaurants, real estate brokerages, and on and on and on. And he's raised money from friends and families, from VCs, some investment banks like Merrill Lynch, CVC Latin America, Citibank. He's done it all. He's been involved in over 55 companies purchases personally. So welcome to the show.
Thanks, John. Thank you. Happy to be here. Excited.
Hey, I got to tell you, I ordered this book from Amazon. It comes fast. I'm in their program. And I read it really fast. I got to tell you, I love this. From the very start of this, you talk about how to outreach to people. I mean, this is nitty gritty stuff, like the letter, sending out a letter, and you give the letter. And I got to tell you, I'll talk about this, how to get it opened. You recommend buying black or dark envelopes so they think it's a personal letter. Yeah. I mean, that's great.
Yeah. It's tactics. It's tactics, right? So what I try to do, and I mean, this is what I've done in the past, right? So everything that's in the book and in the program, I've done personally, and I continue to do today. And it really is all about getting to the decision maker, establishing rapport, so that then you can start talking about buying a business.
Yeah. How many do you send out a week or a month?
Well, honestly, right now, I've got such a deal pipeline, John, that I don't need to send things out, as many emails or envelopes or social media posts, because I have so many tentacles out there. People know who I am. They know I'm serious. They know I'm actively looking to buy and sell businesses. However, when I was doing this, probably at the earlier stages, I would send out maybe 50 envelopes a week. Okay. And out of those, this is important, out of those 50 envelopes, I'd research probably 50% of those companies, right? So these are companies that I am targeting. And what I mean research is I will go and get information on that company to make sure I'm not wasting my time, because it's hard enough to get in front of someone to later then realize that was never a good business for you to begin with. So I try to do a little bit of the homework up front. So there's more than just sending the envelope or getting the address, right? I would send probably about 50 emails a week as well. There's a rhyme and a reason to that. You don't want to become spam. You don't want Google or any email provider to think you're spam. Yeah. Right. So there's a number of emails you should only be sending out in a given time frame. Now that's probably changed, and I'm not a Google guy. I'm not an email guru or anything like that. And then social media posts, I do those all the time. I still do those. I do them more specific, meaning if I'm looking, so I'm actively looking for pool service companies right now. So
pool service companies?
Routes, like a FedEx route, but a pool route. It's just a simple business model, recurring revenue, easy to scale, low fixed overhead. I just bought one about a year ago, and I really like the business model. But anyways, in the social media posts and the outreach, which I talk about in the book, is all these are strategies on how to find businesses, right? And so I put specific industries that I'm looking for when all the other ones are not giving me that much return, I guess, right?
Yeah. So how did you come across? I used to pay a pool route guy, and it's reoccurring revenue, right? you sign up and you just send them 50, 90, $150 a month to clean your pool and do everything else. I mean, how did you come across that? And to me, it was just a one guy operation. So buying his business would probably be, he's got a P&L on his napkin. So it wasn't really anything. How did you find pool companies that's sizable enough to make sense for yourself?
Right. Well, I mean, I wasn't looking for it. It's like everything else. I talk a lot in my book and in my programs that you really need to know your deal specification. It's very, very important. This is what you want to buy and why you want to buy it, right? Do I want to buy a scalable business or not? Do I want to buy a restaurant, or I want to be in that type of industry or not? Do I want $1 million company or $100,000 company or not? Do I want to be owner operator or absentee or hybrid of thereof or not? Right. So all of this is your deal specification. Because I am industry agnostic now, because I bought over 55 businesses across 18 different industries. I'm industry agnostic. So I'll look at oil and gas deals. I'll look at pool routes. I'll look at FedEx routes. I'll look at meat distribution companies. I'll look at home services companies. And the pool route one just happened to come my way vis-a-vis my pipeline.
Yeah.
Now that I bought it, and I bought it for the reasons that have been validated, which it's a simple business. One, easy business model. Two, recurring and predictable revenue, right? Three, scalability, right? So those three reasons are the reasons why I bought it. Have they proven to be true? Yes, absolutely.
Yeah. So how is it, help me out on the scalability, and just like you're talking to the audience, because my guy that I hired was just a mom and pop,
yeah.
And he kept leaving the freaking door open, the dog get out. Like, dude, you're fired. I mean, you did that twice.
Correct. So I'd say 90%, 95% of these pool operators are mom and pop. So they have, it's their job, right? So they own a job. They own this business, but that's how, that's how they get paid, is based off of the profit. They're not necessarily businessmen that look to scale. They don't know how to scale. They don't know how to hire. They don't know how to get financing to scale, right? You get more businesses, you get more clients, you get more residences, more pools, you need to get another truck. How do I buy another truck? How do I hire someone? How do I train them while still, managing and operating my business? So all of these things are very normal for the small business owner operator type. And so that's why it's a very fragmented business. I bought a business or a route that was already established. It was not owner operator, that had more than one route. I don't want to give too much away, but it had multiple routes. So it had an infrastructure already. It had multiple vehicles. And so now I've got an ability to put processes in place, which is key to scaling. Making sure I have the right people, which is key to running any business, and scaling. I'll manage the growth. The people have to manage the company, the day-to-day operations. So if you don't have the right people in place, then the growth and the scalability is going to, go by the wayside. So it was scaled enough, and now we're scaling it so where we can double it, hopefully in a year.
Yeah, that's just hey, there's a new house, here's a new address, do the same thing you did at that last address. The weird thing about the pool stuff is, just over the COVID stuff, our chlorine went from like $20 a case to it doubled in a very short period of time.
Yeah, there's a big shortage right now in the industry for industry specific reasons. So it happens in industry sometimes, and it's happening in the pool industry. Chemicals are scarce right now, tablets, chlorine, acid, whatnot. It'll pass. So we're all going to go through lower margins for a couple of months or a period of time. It'll pass.
So what's your plan with this? I mean, keep it for a period of time, you grow it and then flip it, or does it go in a portfolio?
Yeah, well, I'm very clear on why I entered the business, right? I'm very clear on, I want to buy this business because I want to, there's a lot of room for efficiency, for instance. right? So I'm able to put in those efficiencies. I want to buy this business because I can scale it, right? And then sell it at a higher cash flow, which will garner a higher multiple, right? So I'm very clear on that. Time frame, I'm not too clear on because I don't know much about the business, and I don't know much about what that implication of that scaling or efficiency does. Now, I'll give you a great example. In 2008, we bought a bar. I bought it with a partner. And first thing anyone would say is, why a bar? It's the nightclub. That's the idiosyncrasies of that business. It's late night. It's alcohol. It's rowdy behavior. It's unless you want to be in that, most people don't, and I certainly don't, right? But I realized that the bar was, it's been operating for 9 years, stable clientele. I could buy the real estate, and it was absentee, but there was room for efficiencies, right? When you buy a bar or a restaurant or a retail store, it's very difficult, if not impossible, to scale because you're confined by physical space, right? Or production, right? If you look at a restaurant, your dining room is your clientele, right? You can only fill the dining room so much, right? But you're also constrained by your kitchen capacity, which would be your factory, right? So you're constrained on both ends. At a bar, you're constrained by the physical capacity, but you're also constrained by the bar, which is your production facility, right? So I knew it's not a scalable venture, but there was efficiencies to be had, right? So that's why I bought it, right? We implemented those efficiencies. It was one of the best returns of my investments. Under 7 months, all my money back on the business purchase.
Wow.
So from a financial standpoint, a home run. I mean, a major home run. And I kept it for 13 years, John. Why did I keep it for 13 years? Because I had no reason to sell it.
Yeah.
It was steady, predictable cash flow.
Yeah.
So I didn't have a time frame. I could have flipped it 3 years into it, 5 years, 7. We actually sold it, complete serendipity, the month before the COVID pandemic started, March of 2020.
Yeah, I'd say you got lucky on that one.
We got lucky, but we still would have made it through the pandemic. I have other businesses that suffered, and we made it through. We suffered, like all small business owners. That we all suffered. But so getting back to your question, I'm either making it more efficient or I'm either scaling it, because that's really what you could do with small businesses. Then what happens? When do I flip it? If you want to, use that word, flip it, or how long do I keep it? I don't know that till I'm in the business.
Yeah. Did you ever get any of those calls late at night? Somebody bought too much alcohol, got in an accident, and now they're suing the bar, or fights or anything like that?
No. I mean, it happened, but we had, we had good management in place and a good process in place. So the people and the processes managed the problem. So in the case of a bar, the problems would be fighting, rowdiness, drunkenness. So in the case of the pool business, complaints, lack of raw materials. The people and the processes should address any problems. You have good management, good people with good skill sets, and more importantly, amazing work ethic, then that's what they're there for, right? To solve those problems, to address them. So while they existed, John, I as the owner did not have to address them personally, right?
And do you look at a restaurant and say, hey, this is the management, but you really don't know the people in there just yet until they perform for a while. So, they're right. You make that judgment call and say, well, look, if for me to add revenue, for me to do what I want to do, I need to find somebody else.
Yeah, and that's a great question, because it all goes back again to your why, right? So we've had chefs that have come into this business, to my programs, and they're dead set on buying a restaurant. And we challenge them on their whys and their deal criteria. And most of them want to scale a business. And we go back to, look, you can't really scale a restaurant because of the physical, what we just discussed, right? And they end up changing and going into another industry. So these are chefs that have skill sets and a passion, but scaling is a priority over those. That's the importance of understanding your deal criteria, right? One of my deal criteria is that I need to have strong management in place. I'm not an owner operator. At any one time, I have 4 to 6 businesses that I own. I can't be an owner operator. It's impossible. Right. So I have to have good people in place. Will I change them? Yes, maybe. No, it all depends on the business, right? But that's something that I look for as an important criteria when I'm looking at deals at the very beginning. Is there people in place? Do they have longevity? Do they have the skill sets that I need to run this business once the seller is out, who's the current owner, and we're in? And maybe I'll change them, but at least in the beginning, as I get to know them, as I get to know the industry, and more importantly, as I get to know the business, I can make those judgment calls, but the business continues as before I bought it because the people are already there, right?
Yeah. How do you master the ability to work above the business when you have so many different types of businesses you work in that have different KPIs and metrics, like a software business versus a restaurant business? I mean, they're two different, like, ring the bells to get more money thing.
Yeah.
How do you?
That's a great question. And it really comes down to the 3 Ps, right? People, processes, and the product.
You must be a big fan of Marcus Lemonis, because that's a
I know he talks about it a lot. I used to watch his program, but it's true. I mean, everybody talks about this, right? So if we know that the product or service is already good because you're looking at a cash flowing, a profitable business to begin with. So the market has already accepted that product and service. So you can kind of check that. Can you make it better? Absolutely. But it's already been accepted, right? So the product or service, that's one of the P's, is always good if you're buying a profitable business, right? So then it comes down to people and processes. I'm very good at processes and I'm very good at people. I after so many years doing this, and before I was an entrepreneur, you got to be good at these things to make it, to be successful, right? At being an entrepreneur.
Let me ask you that real quick. Do you, when you buy a restaurant, do you just jump in and go, hey, what are the metrics for the restaurant business? Like, do I go watch Bar Rescue, like 1,000 times?
I learn on it. So whenever I buy a business, normally during the first, call it 1 to 3 months, I'm in the business. I'm going to be going to that business on a daily basis or almost every day for many hours, because I need to understand the pulse of that business. What makes that business tick, right? I have to, because the only way to manage or supervise remotely as an absentee or semi-absentee owner is to understand the pulse of the business, right? So if I buy a restaurant, I need to know that on a Wednesday between 12 and 1, we normally get maybe $3,000 in sales, which equates to about 100 tickets. So if I look at the app and I see that we're at 2,000, I'm going to call the manager and say, what's going on? So I'll have that already, that, I guess, KPI already ingrained into my mind, right? That there's something there. I'll also see the labor. And I know from owning 7 restaurants and bars that above a certain percentage point of the day's sales, your labor is too high. I'll call the manager, get rid of some of these people because they're hourly. When I start seeing those KPIs, but I need to already understand those KPIs, right? And during the first 3 months, that's when I learn the intricacies of the business. That's how I've been in 18 different industries. Think about that. I've gone into 18 different industries without ever being in that industry before.
I guess it's like sound like a Marcus Lemonis, because that's all he does is looking for people, process, and products.
Yeah.
And completely unrelated candy to gifts to whatever.
Yeah, but he goes to what I do is he goes to the foundations of any business, and making sure that those are running great. What he does though is he takes distressed businesses and implements his knowledge to turn them around. I've done that before. What I've realized it's just not worth your time, because you may be able to turn them around, but not get as much profitability for the immense amount of effort and resources it takes to turn it around. So let's just buy a good operating profitable business from the get-go.
Yeah. Yeah. No, I tried that turnaround stuff. It is emotionally draining.
Yeah. So there's a lot of risk. There's a lot of investment and resources at the beginning, but you're not necessarily getting the additional reward for it.
Unless somebody gave you the business. And even if that's a question.
But even then, there's no guarantee, one, you're going to be able to turn around. And define turnaround. Is it not losing money? Is it making money? But what is that? 2% net profit, 10%, 20% net profit? That's night and day. So it's just a lot harder. And there's so many businesses out there, good, solid, strong, profitable business out there to buy, that I don't need to be messing with, turnarounds.
Yeah. Any of these industries that you worked in, would you say, oh man, I'm not touching that industry again? It's just whatever it is, people, product or process. Yeah.
No, there isn't one industry that I've gone into and said, I'm never going to be in this industry again. That's never happened. Some industries are harder than others.
Yeah.
Some industries have, but it's kind of a trade-off, right? Like the restaurant industry, it has a lot of turnover. Right. And so if you have the right management and the process in place to address that risk, or that intricacy of that industry, then it shouldn't be a headache. It's just part of the industry. Right. So in the pool side, it's you don't know what you don't know. In other words, clients usually don't change pool companies unless you really screw up. Right. And so you got to screw up 4 or 5 times before they're like,
leave the door open and your dog gets out. Yes.
Right. And so when I see that, a client usually doesn't call you to tell you things are good. They just forget about their pool because it's being addressed. You're doing your job. Yeah. So they don't worry about it. So they're not calling you. The only time they call you is because there's a problem. Either their equipment doesn't work, or you didn't do a good job on the cleaning side, right? So from an owner standpoint, I don't see those 5 strikes, so to speak, until you lose a client, right? So how do I, as an owner now, again, it's the intricacy of this industry. How do I, as an owner, start getting alerted at the red flags, or making sure the managers are addressing them in time, so that we don't get to the 4th or 5th one where they're like, all right, that's it, too many strikes, right? And so that's all about training and people and processes.
Yeah. I got to tell you, you're probably lucky you got out of COVID, because finding people to work with. I had a buddy that got out of college, and we went to college together, and he got out and he went to a training program for a restaurant, one of those choice fresh restaurants. He said, man, I get like daily people walk up and we turn off a piece of bag. Hey man, I can't show up. I got to go to a concert. It's a turnover. He just hated that. Yeah.
Yeah, it's been a challenge. I don't think with the stimulus checks and the unemployment benefits that have been out there over the past year and change, it has definitely been hard for small business to find good personnel. I mean, it has been. That's just, doesn't matter whether you're in the restaurant industry or the pool industry or the fabrication industry or the trucking industry. It's hard to compete, because small business, by definition, they employ people that get paid usually less, right? Small businesses don't pay $250,000 salaries; they pay $15 an hour.
Yeah.
Right, and those are the people that said, I'd rather stay home because unemployment is as good or just as good without me doing anything, right? Yeah. So it's definitely been a challenge, but I see it waning away. Month after month, there's more personnel in the pool market.
Yeah. Now you said you own 5 or 6 businesses at a time. Is that like kind of your cap, your capacity? And if you go, hey, I'm down to 4, I need to go to find a business, or doesn't matter? It's targets of opportunity.
Yeah, there's no formula. That's just, as I look back, that's just the way things have panned out.
Yeah.
I mean, there's been times where I've had 2. There's been times where I had 7. 2 of them were in the process of being sold, but they hadn't sold. So they're still my businesses, right? So that's just the way it's been, John. There's absolutely nothing to look into that. It's just by chance. So I've been with 1 or 2 businesses, and I've been with 5 or 6. On average, it's been 4 to 6 at any one time.
Yeah. Do you look at a business like, and you say, well, look, I could buy it at this multiple, but even if I do put people, product, and process in place, it's still only going to sell at, 1.2 or 5 point, whatever it is. It just doesn't go up that much, even though you put all the stuff in place, but it has great cash flow.
Yeah. So when I implement, the people in the process primarily, and we do where possible, we do of course improve the product or the service.
Yeah.
Right. So we do address the 3 Ps, but if I'm able to address those 3 Ps, I should have some sort of financial result. So meaning I should have efficiencies. And if I have efficiencies, that means I'm going to have a better cash flow. And if I have better cash flow, even if I sell at the same multiple that I bought it at, I'm selling it at a higher price than I bought it at. And in the meantime, I'm getting an annuity, a cash flow.
Yeah.
Right. So I'm preserving my capital, getting an annuity, getting a return on it, and then selling it and getting at least my capital or more. If I've scaled the business, then it's a double punch, meaning I scale it. Cash flow is now going to go up because I'm scaling the revenue. So I'm going to scale the cash flow. Cash flow meaning free cash flow to the owner or profitability. And if I scale it higher, right? Let's say I buy a business. I'll give you an example. Let's say I buy a business, stood about $1 million in revenue and $150,000 in free cash flow, and I scale it to $3 million. Then the cash flow is going to go up maybe to $400,000 to $500,000. Well, when I bought it at $150,000, I'm probably going to buy that business at a 2 to 3 times multiple. But a $500,000 free cash flow company is going to sell between a 4 to 6 times multiple. So now I'm selling a business that I've been able to scale with more cash flow at a higher multiple.
Yeah.
That's where you make real wealth.
Yeah. Do you have a deal team that comes in and kind of takes over the business and go, hey, we need to do this, this, and this, like to work on each one of those people, process, products?
I do, but it's not as organized as a lot of people might think, right? Because it's small business at the end of the day, right, John? So I don't want to have this big holding company that's sucking up expenses.
Yeah, like that you owe $10,000 a month or $50,000.
Correct. You don't want that. So a small business by definition should be self-sufficient and make money. And if you have good management in place, then I just have 6 managers or 5 managers or 4 managers reporting to me. So I don't need someone up here. Now I do have a deal team when I'm doing the due diligence and when I'm doing things like that, I do. I have had, and I do have administrative assistants that help me, but that's just for my comfort as opposed to operations.
Yeah. So let me ask you about how now we already talked about how to find in the business, and like a lot of people I have in my mastermind, it goes like, how do I find a business? Well, you just got to get out there and create massive action to get that deal flow going, and very specific about who you're going for. But a lot of people get stuck at the funding the business, and I know there's the SBA, but one of the chapters you talked about is the equity and the asset. You really lined out what the difference between buying the assets of the business and shaving off the liabilities and the equity. But can you tell me a little bit more about why that was such focus of 2 to 3 chapters? I loved it because I'm looking at business where it's public, but it's not really trading. It's an OTC market business, and it's got $2.8 million in cash now, and that's like, get the business to buy the business. I don't have to really do it. Yeah.
Well, so a lot of people. So just to your audience, I buy a lot of businesses without putting any of my own money down, right? So
Yeah.
that's meaning I don't come out of pocket. I don't have to use my capital, whether I have it or not. My students haven't had to use their capital, whether they have it or not. And so there's various ways, creative and strategic ways to fund the purchase of a business without coming out of pocket, right? One of those is to buy the actual entity. So it'd be an equity purchase. Now, the asset purchase is the most commonly used, right?
Yeah,
so it's
yeah.
you value the business, you're still buying the business. The legal purchase is an asset purchase as opposed to you buying the shares of a company. The reason why you would do that is because of all the contingent liabilities that are out there, right? That are impossible to uncover in a due diligence, because these are not audited financial statements. They're not reviewed financial statements. Some of them are on paper napkins, right? For all you know, and there's a lot of personal and non-business related expenses that maybe
Entanglements with the personal part. Yeah.
Right. So it's not as professional, right? And so there could be a lot of contingent liabilities. So when you buy vis-a-vis the asset, you create a new company, and then you buy all of the assets, all the clients, all the cash flow, all the goodwill, and you transfer everything to the new LLC. And so if one of those contingent liabilities were to pop up, let's say a disgruntled employee sued the company, well, they can't sue you. You never employed them. The old legal entity employed them, so they would sue the sellers,
Yeah.
the old owners, right? So that would be an example of getting away from a contingent liability. However, when you're trying to put together the puzzle of doing 100% finance deal, one way of doing it is to assume existing liabilities. And the only way to assume existing liabilities with financial institutions is to keep those loans where they are. And they're with the existing legal entity of the seller that you're buying it from. And so it's instead of you going to a bank and explaining them the deal to get new financing, you can just go to the existing bank that's already financed, something about the business, whether it was equipment purchase or whether they have a line of credit or whatever it is, and say, I'll just assume it. They already know the business. They don't have to start a new file. You still got to sell it to them, but they're already getting amortized. They're already getting paid. They're happy. So 90% of the convincing a bank to finance you is already done for you.
Yeah.
And assuming that loan, but again, the only way to do that is to keep it with the existing LLC, incorporated, or legal entity. So that's that. In those cases, you would buy it as an equity purchase as opposed to an asset purchase. But then you'd have to write very, very strong, representations and warranties in their legal documentation.
Yeah.
Right.
But would that also take, like, say, if the business was for 5 million and the liability is 2.5, you just say, well, I'm cutting the valuation of the business by 2.5 because I'm assuming the liability.
No. So here's what happens. That's a great question. So let's say you're buying a $5 million business.
Yeah.
That's the purchase price, as you said, and they have $2.5 million, and let's just call it one bank loan, right?
Yeah.
So in an asset purchase, you're going to come to the closing table with $5 million, right? And simultaneously, now the seller has to sell you everything free and clear of any liabilities, right? So simultaneously, that seller is going to use the proceeds and pay off that $2.5 million loan.
Right.
So the seller's going to net $2.5 million. The business is still worth $5 million, but he or she's got to pay the $2.5 million off. That's the difference between enterprise value and equity value, right? So that's an asset, right?
So if you said, hey, I'm gonna purchase the assets and assume your liabilities, I'm gonna go to the bank and renegotiate it as the principal, but I'm only going to buy it for 2.5 because I'm assuming your liabilities.
No, you're still buying it for 5,
Oh, you still buying it for
but,
5?
but the business is, you assume $2.5 million of a loan. Think about it from, let's go back to the asset, right? So
Yeah.
$5 million purchase, you've got to come up with $5 million, right?
Yeah.
So you're gonna have to go to talk to banks or investors or do other creative things that I talk about in the book and come up with $5 million, right? A bank may lend you $2.5 million, but you've got to go through the whole business plan with them. You got to walk them through the deal. You've got to them, they've never seen this business, right? And hopefully you'll convince them and they'll lend you money. Well, in an equity deal, if the business already has $2.5 million, you don't have to do all that because they already know the business. They're already banking. They're a client of the bank. All you have to do is convince them that you're going to be a good owner, right? And so you've already financed 50% of the purchase with the help of the seller. Make sense?
Yeah.
You don't start from scratch. You've already got 50% of it financed. Now we got to go find the other 50%, and that's a lot easier.
Yeah.
You add in credit card financing, you add in equipment financing, you add in owner financing, and suddenly you have a 100% no money down deal.
Yeah. How much are you involved in raising capital aside from doing no money down stuff with banks? Like just having a fund, or it's always a big conversation I have with people in master. And I go, hey, I got to start a fund. I need money to be able to buy businesses here.
Yeah. Well, I've been approached hundreds of times to raise capital.
Yeah.
Right. But if I don't see any benefit for me, why am I going to raise capital for a third party? I've already done that when I worked in Wall Street and KPMG, and I've raised a lot of money for my businesses. But I wouldn't do it for somebody else because it's not worth my time. Right. So to put together a fund, remember when you raise money, we got to get into the intricacies of a fund and how they make money. And when lenders or investors commit money to a fund, well, that money costs money, right? And if you don't have active deals, it's still costing you money to have those funds, whether they're deposited in a bank account or committed. There's no point in that. I can raise money for a business purchase all day long, so I don't need to have a fund for my deals.
Interesting. Yeah. So when you have a deal in your deal flow, you have a network of investors and say, hey, look, I'm going to need, $500,000 to put as a down payment, and here's the business. Is that what this looks like? Yeah.
Yeah. So yes, I have a strong Rolodex. Fortunately, I've made people money, a lot of money, and yes, I call, my friends, family, and fools, right?
Yeah.
They're not fools anymore because they've made a lot of money. So no, I have accredited investors, I have angel investors, I have VCs, and more importantly, I have lending institutions. That's the majority of the money we raise to buy a small business comes from debt, not equity.
Yeah.
Equity is the most expensive type of financing. So if I can get a bank, I'm always going to get a bank. If I can get a financial institution, I'm always going to get a financial institution.
Yeah. What kind of debt to cash flow ratio do you look for in a company to cover it, to cover financing? Yeah,
there's no black and white. We have a formula. If you came into the program, we give you this financial spreadsheet where it's kind of plug and play, where you have the cash flow, you put in the debt that you're raising, and you make sure that after you service that debt, there's still an acceptable rate of return in terms of cash flow for you.
Yeah.
Right. And only you can make that decision whether that's good or not. So, but there is no debt to cash flow ratio because every deal is very different.
I put something together for a friend and I sent it off, which was kind of timely because the business he had Target already put an LOI on had 2 bad quarters. So he had approved for SBA and they said, no, we're out. Like, because they hit a 50% decrease. They lost money the last 2 years.
Yeah, well, I mean, that's, so when in my program, I have students that come in and they got these starry eyes because now they want to become instant millionaires, right? And these are people that have never owned a business and are buying a business for the first time. They have very little capital. And now they want to buy a multi-million-dollar business. And this is what I tell them, because what we do is we do what's called a leverage buyout. It's been done for 40, 50 years, right? The 80s was the height of the LBOs with Michael Milken and Ivan Boesky and Ron Perlman and Ted Turner and all these guys. The leverage buyout, so if you don't want to put any money down, then you're going to have a lot of debt, so your business is going to be leveraged. By definition, that's what a leverage buyout is, right? So when I tell these guys that have these starry eyes and suddenly want to become multimillionaires, I ask them, I say, look, if you bought a $5 million business and you brought in $5 million worth of debt, and that business, for whatever reason, went under, COVID, bad management, Hurricane Harvey, whatever, whatever happened, a regulation that destroyed that industry, oil plummeted, whatever was the catalyst, can your lifestyle and your life sustain a $5 million blow? Can it? Because if not, then you can't buy that business, because that's the downside of taking on that debt. You're going to be personally guaranteeing that debt. So I know you're starry-eyed, but you've got to understand the consequences. If after I tell you this and you understand the consequences and you still want to go forward with you, all power to you, right? I don't want to dissuade you. I just want to open up your eyes. And so there is that risk of, that debt, crumbling in business.
Do you, when students come through your program and, let's say they don't have the greatest of credit ratios and they can't really borrow much based upon their personal guarantees or something, do you get involved and you say, hey, it's a good deal, we just need to raise more money to be able to close the deal?
Well, here's the thing. The financial institutions are looking at the cash flow, at the business as they're analyzing the credit.
Yeah.
Right? You're just an extra layer of insurance policy, right? So said another way, they're not going to lend to a bad business if you have amazing credit, right? So they're only going to lend to a good business. Now, your credit is just an insurance policy, right? So it's not that difficult to buy or to get approved with not stellar credit. That's a myth out there, because again, unlike buying a home where the home is the collateral and your credit is important because the home can't pay for the credit, it doesn't produce income, right? So it can only pay for it
if you're paying the bill, right? In the case of a business, they're looking for the business cash flow to pay to amortize and service the debt. So long as the business is making money, then it's making money before they have to foreclose. It is producing income. Yeah.
It is servicing debt.
Any of your students like just taking off, like, oh my God, this is an eye opener to a new dimension?
Yeah.
So it's like 10 businesses or something like
that?
Yeah.
I've had a couple, and again, I've had students from all walks of life. I've had bartenders, waiters, plumbers, current business owners, millionaires, retirees, internationals, nationals, 20-year-olds, 70-year-olds, men, women. I've had everything that's come through. And yes, I've had students that get it, it clicks, and they're smart, they're disciplined, and they reinvest the money that they're making on one business on a second one and a third one.
Yeah.
I had one student that in a period of 3 years bought 5 businesses in different countries.
What? Yeah.
I'm like, I haven't done that, so all power to them. Yeah.
Yeah. Hey, you talked about buying a football or soccer company or tournaments or something like that. What was that story on that.
Yeah, it was more transaction based. So it was putting together. So in the soccer world, I don't know if you're a soccer fan, John, but they have these times during the year which are called FIFA dates, right? Where all the clubs, the leagues stop, and everyone goes back to their national teams, right? So all the Spanish players go back to Spain, all the United Americans go back to the United States, all the Mexicans go back to Mexico, et cetera, and they play for the national team, right? So during that time, the clubs, so all the clubs that play in the MLS here in the United States, or in the Liga in Spain, or in the English Premier in England, well, those clubs, what do? All the players that do not go to their national selections, well, they have friendly matches, right? So they establish friends. So this company puts together friendly matches between rivals or teams from other leagues, like a team in the Argentinian league playing a team in the Mexican league, right? Which you would never see or almost never see. And that's what they did. And it's just, if it was a good game and you had good, turnout, you have a very positive financial return.
Yeah. I think a lot of this comes back to your ability to read people, like getting into business with somebody or buying their business, is being able to read them. I mean, what do you attribute your skill of being able to say, hey, I know that guy's, I'm looking into his eyes and I can read him. He says he's unethical, even though, I'm just making a wild blanket statement, but say, hey, he's unethical or he's not going to show up on time. But what do you attribute that to?
John, I think it's experience, right? I've been working and I've been an entrepreneur for 25 plus years. For my own businesses that I've bought, I've had over thousands of employees now. But I've also managed a lot of employees when I was in the corporate world. And so after being through so many industries and so many layers and so many different hats, you just get a knack of understanding people, and I'll tell you something, buying a business, and this is important for your audience to understand, is the techniques, the tactics, the valuations, the financial structure, the multiples, the legal documentation, the due diligence. That's about 20-25% of the deal.
Yeah.
That's actually easy. It's the psychology, the art of the deal as we come to know it. That's where the real bread and butter is, right? Knowing how to read people, knowing the psychology. Why does someone sell? How do I position myself so that me knowing why they're selling makes me the better buyer, the better prospect?
Yeah.
How do you do that? And it's understanding the psychology, it's asking the right questions, it's positioning yourself, and that's got nothing to do with tactics. It's got everything, business tactics, it's got everything to do with art and psychology, right?
Yeah. You actually talked about that in the book. Like you have 3 to 5 pages based upon what happens in the first meeting, second, and third.
Yeah.
And you're very descriptive about that too, because it works. Like I had a meeting with a guy today, my first meeting, and we didn't talk about any numbers, anything else. I'm just trying to figure out why you've been thinking about selling. What are you going to do? What do you like to do? And then I saw something in the background, and I could tell it was a Corvette thing. And I started asking about the Corvette stuff, and he opened up about that for 5 to 10. I'd like to go on Pacific Highway 101, riding with my wife. Like, very cool. Do you have a 2020 Corvette or something, the new one? Yeah, we just bought the mid-engine one. Love it. So fast. Like, yeah.
Yeah. So what you were doing is you're establishing rapport, and rapport leads to trust, and trust leads to, hey, I could sell to this guy.
Yeah.
Right. And at the same time, in parallel, you've already planted the seed in his mind that he can sell. And so that retirement plan, that exit strategy is already playing in his mind. And subconsciously, the two are working for your benefit.
So it's like if me doing this is helping him put all the puzzles together so we can go riding in this Corvette on Pacific Highway 101.
Correct.
Yeah.
Correct. Absolutely. And that's the part that, you know, a lot of people say, Arturo, you know, this got to be easy for you because you bought 55 plus businesses. I'm like, every time I go to a new seller, the last thing I tell them is that I bought 55 businesses. That gets me nowhere.
Yeah.
I need to establish rapport. I need to be humble. I need to listen to him. I need to ask, or her, I need to ask the right questions. I have to get him to trust me. I have to establish that rapport, John, that you did with this gentleman. Me giving them all my accolades or what I've done, that doesn't establish rapport. That might even scare them.
Like, okay, you're bragging, great.
Yeah, or
What are you gonna do? Like
oh
a
God, I'm dealing
chainsaw?
with someone that's going to take advantage of me.
Yeah,
You know,
chainsaw out and
it-
just
it-
get rid of my people and cut costs.
Correct.
Like, yeah,
Correct. So again, and that's understanding the psychology of the situation, right? And I have to do that every single time, and happy to do it because I do want a win-win scenario. I do want them, you know, the business owner, the seller, to feel good about the deal because they're gonna help me in the structure, and they're gonna ultimately, most likely to not, gonna be a creditor if I get owner financing. So it behooves me to have a great rapport with them any way you look at it,
yeah,
genuinely.
yeah. How often do you buy businesses out of town and you go visit them on the second meeting or third meeting? How often is that?
Not much. I've had a lot of students do that, and it works fine. I just haven't found the need to do that. I've looked, and then I'm comparing buying a business 2,000 miles away, which I like, but then I also have a good deal here, 20 minutes away. Why make it harder?
Why,
So I always
that just added risk to the business.
Yeah. So
Yeah.
why, all things, kind of, stable. This deal over here is going to be harder to manage than this one. Meaning that the long distance one is going to be harder to manage than this one. And if they're pretty similar, I'm just adding an additional layer of risk unnecessarily. Now, if it's a better multiple and it's a better cash flow and there's more to that deal, but it's always been, John, with my pipeline of deals that have come through, I always have good deals locally. And so I have defaulted locally by chance. But I have looked many times in the New England area, in New York, Connecticut, Massachusetts. I've looked in California. I've looked in Arizona. I've looked outside of the Houston area where I live, in Dallas and San Antonio and Austin. But I always come back in Florida. I've flown a couple of times to Florida. Almost bought a business out there, a car transport business, but always fell back to a good deal here.
Yeah. And so you don't mind capital intensive businesses, kind of like a car transport business or the oil business. Jesus. Yeah.
No. I haven't found an industry yet that I've said this is not a good industry. Right? I haven't bought a business in every industry. Obviously, I bought business in 18 industries, but I have yet to find an industry that I don't like.
Yeah.
That I think is too difficult or too complex.
Highly regulated or anything like that?
Yeah, I'm sure there are. I just haven't, I haven't seen it. I haven't discarded anything because the industry by nature has it's difficult or complex.
Yeah. Well, Arturo, I got to tell you, man, an hour goes by. I love these conversations and I appreciate the time you spend with me. So I just want to tell my audience about this book. I reached out to Arturo. They said, what book? He's got a couple. And I asked him what book you should buy. And he recommended this one, and Buy Yourself into Entrepreneurship. And I'm a premier user on Amazon, especially an M&A book. So I loved it. And I want to thank you for spending time with me.
Thank you, John. Appreciate it.
All right. And that's